My name is Rahul Pal and I head the fixed income desk at Mahindra Mutual Fund. Today we discuss the month of February that has gone by in the debt markets and a bit of an outlook from there on. So I divide the market of February into three buckets: the pleasant, the not so pleasant and the interesting. So it's always good to start with the pleasant things first. So the pleasant part: the Monetary Policy Committee of the Reserve Bank of India cut the repo rates by 25 basis points to 6.25. And of course, they also changed the stance of the policy to neutral from a calibrated tightening. The other nice thing about the policy was it did not allude much to the government borrowing program, which was a concern for the markets. CPI inflation, which is the retail inflation in India, which came at 2.05, which was a very low number, and the core inflation came at 5.40, a dip from the 5.70 that we had witnessed in the previous month. That too was a nice thing. And the RBI continued its program for injecting liquidity into the markets through the OMO. So three nice things and the pleasant things which happened in the market. Now of course to the not so pleasant thing. Commodities and crude continued their uptick throughout the month, bothering the markets. The Indian 10-year sovereign rates moved up by around 13 basis points to close at 7.41 during the month. And now I move to the interesting part. Well, of course, the 10-year would have moved up. The 5-year did not do it. In fact, the 5-year came off around 25 basis points to close at 7.02. And the difference between the 5-year and the 10-year is today close to 25 to 30 basis points, which is a remarkable thing, which is something not been witnessed in the last 5 years. There's another part of the bond markets which we call the swap curve. Interestingly, the swap curve has the overnight index swap market. The 5-year OIS rate is today trading at 6.16. This is a historic low, almost close to a November 2016 low of 6.01. So we have drifted. The OIS curve has drifted to a much lower rates as we have witnessed in the last 5 years. We think the spread between 10-year and the repo rate at 100 basis plus offers a very interesting opportunity for the gilt, and the corporate bond spreads. The difference between corporate bond and the underlying GSEC is also at close to 100 basis plus. Both of these are deviations from the past pattern witnessed, and we think these deviations form very interesting opportunity for the debt market investors. Now I discuss the scheme specific strategies. First, Mahindra Low Duration Bachat Yojana. The average maturity of the scheme was around 262 days, and we will continue with this average maturity as we move ahead. On Mahindra Credit Risk Yojana, the modified duration of the scheme is close to 1.9, and we haven't added any new credits, and as the AUM increases, we would intend to increase the average maturity of the portfolio. Mahindra Dhan Sanchay Equity Savings Yojana, the debt portion, the modified duration of the portfolio for the debt part is around 4.10, which has increased from January. We prefer credits over gilts during this time, and in the future we would maintain a larger allocation towards of credits than gilts.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.